Hi guys, and welcome to our podcast. Today we're going to discuss about fixed rate mortgage and why you should consider it when thinking about taking a mortgage. Getting a home mortgage can be difficult. The amount of detail you have to put into the structure is haunting. The sheer number of opportunities at hand can be confusing and sometimes overwhelming. There are a number of these mortgages. The most popular one is a fixed rate. This simply means that the interest rate won't fluctuate over the time you have the mortgage. This mortgage has a fixed interest rate for the whole length of the loan that is taken out. This is a huge advantage for those who are worried about their interest rates increasing or for those who have long-term payments. This also helps with your bills and estimation of bills because the interest rate is stated at the beginning. The rate is determined before the loan is even taken out. There is no guessing on that. You can use this mortgage to figure out your bills in the next month and even for the multiple years without worry over if the price will change or not. You can be sure you will pay the same amount each month. In addition, you won't have to worry if you might pay more next month. These, however, usually come with higher closing costs. It's worth it to point out that the 30-year fixed mortgage is one of the most difficult to get approved for. This makes it difficult to be approved. However, if you find you can get around these barriers, then a fixed rate mortgage makes sense for most buyers. When comparing different things, pros and cons arise for each. Our fixed rate mortgage and adjustable rate mortgage also have different benefits and doubts. For example, with the adjustable rate mortgage, it could have a larger initial payment advantage as compared to the fixed rate mortgage. I should note that since it is an adjustable rate, the interest rate could rise over time. This ultimately can be a worse decision than the fixed rate. You should always compare the pros and cons of both mortgages at the given times. Always take into account the risks involved. When you get a fixed rate mortgage, it's like the mortgage dealer gives you a short-term price rate for the mortgage. Regardless of how the interest rates hike or fall, your interest rate remains the same for the deal. So you could end up not paying a lot of money extra due to the high interest rates. You could also risk interest rates going down and lose the option to save money. Fixed rate mortgages have different types you should know and understand. If you agree upon a 5-year fixed mortgage, you should accept the interest rates to not increase or decrease for the entire 5 years. However, after the 5 years, the fixed rate then becomes an adjustable rate. This creates benefits and doubts. Benefits because the initial interest rate is actually less than a 30-year mortgage. Doubts because after 5 years, your rate could increase a lot or a little. Again, with the risks. One ideal situation for a 5-year fixed mortgage is if you invest and then plan to sell within 5 years. Usually people are drawn to 15-year fixed mortgage rates because they have lower interest rates. You can then pay off the loan amount, not including the interest, faster than a 30-year fixed rate mortgage. But with the benefits, there are also doubts. Be aware that the 15-year mortgages have payments that are higher. Now, when we get to the 30-year mortgages, these are what people really shoot for. Why? It's the most affordable. They do have higher interest rates, but that's okay due to the fact that it's a 30-year agreement. 30 years is a long time. When you think of the American dream, a 30-year fixed-rate mortgage should come to mind. These are ideal when you know you're going to be living in a house for a long time. Side note, this can really benefit low-income families. They are able to afford a bigger house that would ordinarily be too expensive for them. The next important thing you should consider is the interest rate. Interest rates are determined on a multitude of things, including, but not limited to, prevailing interest rates. Since it's an adjustable rate mortgage, ARM, you're paying the same interest rate for the whole length. This rate is determined by prevailing rates at the time. Personal finances. We all know not to skip and overlook our credit score. We shouldn't be surprised that a variable of our interest rate is also determined from our credit score. Also, size of the mortgage and down payment play key roles in determination. These interest rates are based on the individuals. Asking others what theirs might be or using a generic table to determine might not help. Check if you need to increase your credit and how to do it. Closing costs. A lot of people choose to pay a higher interest rate so that their bank can deal with the closing costs. It's not rare and people do it a lot. It's also referred to as a no-cost loan. Look out for this terminology. Private mortgage insurance, PMI. You can choose to have a lender-paid mortgage insurance or choose a private mortgage insurance, PMI. You should expect to pay higher interest rates. The benefit is not having to pay out of your own wallet and instead having the bank pay the price to insure your loan. See how to find the best mortgage lender. Suitability is another factor you should take into account. Obviously, if a fixed-rate mortgage was better for everybody, then the adjustable-rate mortgages wouldn't exist. While these fixed rates can benefit most, and generally all, the adjustable rates still offer their own benefits for others. Broadly speaking, these fixed-rate mortgages better suit the homeowners who plan to live in their house for a long time. Also, those who don't plan to move or sell the house. It also benefits those who plan to refinance the house and plan to keep living there. We've already discussed some of the advantages and scenarios for those with a fixed rate mortgage, so I need to go over some of the benefits of adjustable rate mortgages. These advantages include, if the prevailing rates are already high, go for an adjustable rate. Odds are the interest rates will be knocked down to a regular rate. Not planning on staying for a while? Then there's no sense in getting a fixed rate mortgage. The cost up front might be more expensive than for an adjustable rate mortgage. Sadly, if you have bad credit, you could very well not qualify for one of the fixed rate mortgages. See how to improve your bad credit. If you can't afford the payments of a fixed rate, but you might be able to in the near future, you might have an easier time applying for an adjustable rate mortgage. If you want an example, think about not being able to afford the fixed rate now. However, you could be able to in a few weeks or months, when you know you're getting a promotion at work. Choosing fixed rate mortgages has some great advantages. Generally, a fixed rate mortgage has more advantages than any other, though. These include, but are not limited to, knowing your payments. Your payments are the exact same, from the first month to the first year to the 11th month of the 28th year. This can benefit you greatly, as you'll know exactly how much to expect and how much your payments will be each month. You can definitely budget your finances a lot easier for this reason. This also can define your standard of living. Stable interest rates. Imagine you sign a fixed mortgage rate and then the market for them skyrocket. While this doesn't benefit others, you get the benefit of paying less for your mortgage. So what if you get upset about the mortgage market dropping a lot and everybody else gets the lower rates? Don't sweat. You can refinance and then get a better rate. You should always keep an eye out for the mortgage market. Also, you can really navigate through it and get the best deal. Sometimes you can actually start high and get a huge decrease in your interest rates. Who doesn't love saving money? These fixed rates really help. Imagine getting an adjustable rate and the rate increases significantly. This can make the difference between somebody buying the house of their dreams and happily paying it off and somebody drowning in debt. Paying down the principal. This simply allows you to make added on and extra payments on your principal and not have to worry about fees and penalties. On the other hand, you should be aware also to the disadvantages of fixed rate mortgages. I wish at least one thing on earth could be all pros, no cons. With finance and business? Yeah, right. So here's a list of disadvantages to consider also. Upfront costs. Discount points, origination fees, underwriting fees, and closing costs are all upfront costs. These are often higher than other mortgages. Commitment. If the Reserve Bank cuts the rates again, those with fixed rate mortgages might have the short end of the stick. They'll be paying more since it was decided prior to the interest rate dropping. You can always refinance. This might also bring other variables of difficulties and headaches, though. High comparable interest rates. Like I said earlier, don't go for the fixed rate if you plan to move out in less than 5 years. You can likely get a better deal with a hybrid adjustable rate mortgage. If you decide you would actually like an adjustable rate after agreeing to a fixed rate, you might be in for a bad ride. With the fixed rate mortgages, you have a set term, i.e. 15 years. You would then have to stick with it for the entire 15 years. The only exception is if you decide to refinance, or something that pertains to financing. Qualification difficulties. Poor credit scores beware. Since the payments are higher and the upfront costs are more expensive, those with poor credit scores will probably not be approved for a fixed rate mortgage. It's also worth mentioning that if you want to get out of your fixed rate mortgage, you will have to pay fees and taxes for breaking the contract. Summary. The American Dream, the 30-year fixed rate mortgage, the most popular and sought out mortgage in the competition. It's the most popular because you know what you pay. If you plan to get married and raise children or just live in a house for nearly a lifetime, this provides you with rates up front. This enables you to benefit with budgeting. Not to mention it can help families and those who earn lower incomes. It's good to point out that we are observing more and more people not living in houses for a lifetime. The overall idea of houses and living quarters are changing dramatically with generations. For this reason, I do think that the 30-year mortgage will eventually lose popularity. Therefore, an increasing number of people won't benefit from these fixed rates. Go through what you and your family want and need. Determine what's best for you. Most of all, go through your options thoroughly and in detail. Also, look into the benefits of hedging your bets to consider fixed rates as a part of your mortgage. This permits you to have the safety of a fixed rate mortgage with the flexibility of an adjustable rate mortgage. A lot of home loans give you the option of having a split loan. This means one portion is variable and the other portion is fixed. These splits are all different. The most common is a 50% variable and a 50% fixed, right in the middle. Doesn't that make your OCD as happy as it makes mine? Like I said, fixed rate mortgages typically benefit most. Nonetheless, there are a few exceptions. Determine if you're one of these exceptions. Then go about all your options. Write them down. Pay attention. Ask details. Increase your chances to get a mortgage. Schedule meetings. These are your finances. Don't take them lightly. That's it for now. On our website, you can find more posts as well as mortgage calculators and other financial tools. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube. We would love to know your thoughts regarding fixed-rate mortgage, so feel free to share them in the comments below.